The same ounce of silver. The same trading day. The same world. But in New York, the market says it's worth only $72. While in Shanghai, buyers of physical silver are paying $100 for that very same ounce. Not a small spread, not a rounding error, but nearly a 40% difference for the same metal at the same moment in time. If $72 is the real price, then who would be foolish enough to pay $100? But if $100 is the real price, then who exactly is being protected at $72? And here is what makes this truly frightening. While prices were in free fall, many investors couldn't sell. Orders were rejected. ETF trading was halted. Platforms froze. The exits were locked. Prices collapsed, but liquidity did not appear. The market didn't panic in the usual way. It contradicted itself. So what is really happening? This is not just a story about gold or silver going down. This is a story about which market is telling the truth and which market is lying. And if all you are looking at is the price chart, there's a very high chance you're looking at the wrong thing entirely. What you're about to hear will prove that. But before we go any further, remember to subscribe to the channel and stay with us throughout this journey. If we strip away emotion, if we temporarily set aside talk of manipulation, conspiracies, or invisible hands, there is still a very simple explanation for what's happening. This could just be a normal crash in the metals market. In the months leading up to this move, gold and silver rose at a pace that would make any market uneasy. Prices climbed faster than the underlying economic fundamentals. Speculative capital poured in aggressively, especially through highly leveraged products like ETFs and futures contracts. When prices rise too fast, a correction becomes inevitable. From a conventional perspective, this sequence of events is entirely logical. Real interest rates remain elevated. Global monetary policy has not truly pivoted. Hawkish signals from central banks put pressure on non-yielding assets like gold and silver. For silver, the pressure is even greater. Silver is not only a safe haven asset, it is also an industrial metal, tightly linked to the economic growth cycle. When markets fear recession, industrial demand comes into question, and silver is often sold more aggressively than gold. On top of that, the structure of the modern silver market makes crashes more violent. Most trading does not involve physical metal, but paper silver, leveraged ETFs, futures, options. When prices reverse, leverage amplifies losses. Margin calls appear. Forced selling cascades. On the chart, everything seems to fit a familiar script. Prices overheated. Leverage built up. An information shock hit. Chain liquidations followed. Prices plunged. If we stop here, it's very hard to argue that the market is being attacked. And if you only look at the price line, you might even conclude that this crash was entirely predictable. But it is precisely at this point that a question begins to surface. If this is just a normal crash, why is the market behaving in such an abnormal way? In a normal crash, the harder prices fall, the more liquidity appears. Those who are afraid want to sell. Others see opportunity and want to buy. Painful as it may be, the market still functions. Orders are matched, trades occur, exits remain open. But this time, the story is different. When silver and gold prices began to plunge, many investors discovered something deeply unsettling. They could not sell. Orders were placed but rejected. Systems returned error messages. ETF trading was halted. Some platforms displayed prices but would not execute trades. Prices kept falling, but the market did not expand liquidity to absorb the shock. It shut down. This runs completely counter to how a healthy market responds in a crisis. Historically, even during the largest crashes, from financial crises and tech bubbles to commodity sell-offs, liquidity tends to explode during panic. This time, it didn't. Instead of more participants being able to sell, only prices were allowed to fall. This creates a dangerous paradox. Investors watch their accounts evaporate by the minute, yet have no ability to act. No stop loss, no exit, only the option to stand and watch. A natural crash creates fear, but it does not strip away the right to trade. When exits are locked while prices are collapsing, this is no longer a story about crowd psychology. This is a story about market structure. And it is precisely here that people begin to ask a critical question. Is this really a crash driven by supply and demand? Or is the market operating under a different mechanism, one where prices are allowed to fall, but participants are not allowed to leave? The answer does not need to come immediately. But from this point forward, Simply looking at price charts is no longer enough to understand what is happening. To understand why this crash unfolded in such an abnormal way, we need to step away from price charts and look directly at how the derivatives market actually functions. At the center of that mechanism is margin. When trading futures contracts, investors do not need to put up the full value of the asset. They only post a portion, typically around 10%. The rest is leverage. In theory, margin is a tool designed to protect the system. When volatility rises, exchanges raise margin requirements to reduce the risk of cascading defaults. From this perspective, margin hikes are not inherently bad. They act as a safety valve. They prevent markets from collapsing under excessive leverage. But the problem is not the act of raising margin. The problem is how and when it is used. In the past, margin increases were infrequent, perhaps once or twice a year. When markets overheated, exchanges tightened, then stopped. This time was different. Margin wasn't raised once, not twice, but repeatedly, aggressively, in a very short period of time. Within just a few weeks, margin requirements were raised again and again, causing the amount of cash needed to maintain the same position to surge, even though investors had not added to their trades. And then, a truly pivotal change appeared. Margin is no longer a fixed number. It has been converted into a percentage tied to price. This creates a self-tightening mechanism. The higher the price, the higher the margin. The higher the margin, the greater the cash requirement. The greater the cash requirement, the easier it is to trigger a margin call. In other words, even if you are right about the trend, the system can still force you out of the market simply because you lack short-term liquidity. At this point, margin is no longer just a stabilization tool. It becomes a filter, not a filter for right or wrong, not a filter for forecasts, but a filter for endurance. As margin rises continuously, high-leverage participants are eliminated first. Thinly capitalized players are eliminated next. What remains are only those entities with balance sheets large enough to absorb repeated rounds of tightening. And at this moment, an unavoidable question emerges. If the goal were merely to stabilize the market, why tighten so aggressively? That massive numbers of positions are forced into liquidation at the same time? Why change the margin mechanism in a way that causes the system to squeeze harder as prices rise? The answer does not need to be rushed. But from this point forward, margin hikes are no longer a technical footnote. They become the central axis of the entire story. At this stage, the question is no longer how many percent gold or silver prices have fallen. The more important question is, which price reflects reality? On financial screens around the world, silver is quoted at around $72. That is the price shown on derivatives exchanges, on ETFs, and in the scrolling tickers on financial news channels. But at the same time, elsewhere on the same planet, those who need physical silver are paying nearly $100 for the very same ounce. Not in the future, not an expected price, but a physical transaction price, where metal changes hands, is packaged, and is transported. This nearly 40% gap is not merely unusual. It should not exist in a market that is supposed to be efficient. If silver were truly worth only $72, there would be no economic reason for buyers in Shanghai to willingly pay $100. Conversely, if $100 is the level that truly reflects physical supply and demand, then what exactly does the $72 price represent? Even more striking, this gap does not narrow when paper prices collapse. In a genuine crash, physical and paper prices move together. Fear spreads, demand collapses, everything falls in unison. But this time it does not. Paper prices are in free fall. Physical prices are holding firm. Premiums are even rising. This sends a very clear signal. One market is reflecting financial stress. The other market is reflecting the reality of supply. When those two signals diverge, the problem is no longer about short-term price forecasting, but about assessing the credibility of the pricing system itself. If you believe in paper prices, you must believe that physical buyers are acting irrationally. If you believe in physical prices, you are forced to acknowledge that paper prices are being driven by factors that do not originate from real supply and demand. This text does not need to give you an answer. It only needs to place these two prices side by side and let the question echo on its own. In a finite world, which price truly represents something that cannot be printed? At this point, arguing about whether manipulation exists or not becomes less important. Because even if we assume that every action is legal, every decision follows proper procedure, there is still a much larger question. Can this system withstand the moment when promises are converted into demands for physical delivery? The modern metals market operates on a familiar principle: fractional reserve. A large number of contracts are traded against a relatively small amount of physical metal. Most positions are settled in cash. The system functions smoothly, as long as the number of participants demanding physical delivery remains low. The problem arises only when trust changes. When contract holders no longer want cash, when they want metal, when they want something that cannot be printed. At that point, the equation becomes very simple and very cold. How many ounces have been promised? How many ounces are actually in the vaults? If those two numbers are too far apart, the system does not need manipulation to be at risk. It generates risk on its own. That is why major delivery periods are not merely technical events. They are stress tests for the paper market. Every contract that remains open until the first notice day is an unanswered question. Every ounce withdrawn from physical inventory erodes another layer of the safety buffer. Here, the story is no longer about who is right, who is wrong, who is good, or who is bad. It is about the ability to fulfill a promise. A financial system can operate for many years on trust alone. But when trust is tested by demands for delivery, only one metric remains: is there enough metal or not? And it is precisely at this point that margin tightening, position cleansing, and forcing participants out of the market before delivery dates begin to take on a different meaning. Not to predict prices, not to stabilize short-term volatility, but to reduce the number of people who are allowed to ask the most dangerous question of all. Perhaps the most important takeaway is not the question of where prices are going. In the most stressed phases of a market, price is often the greatest distraction. What truly matters is not found on the chart, but in the behavior of the system itself. There are signals that require no complex interpretation, only simple observation of whether they align with one another or contradict each other. Is the gap between paper prices and physical prices still widening? Are metal withdrawals from vaults continuing? Are borrowing costs for metal remaining abnormally high? Are expiring contracts still being held right up to delivery dates? And most importantly, do trading platforms continue to experience disruptions as volatility increases? These signals will not tell you whether prices will rise or fall tomorrow, but they tell you very clearly where the system is under pressure. In every monetary and commodity crisis throughout history, those who failed did not fail because they were wrong in the long run. They failed because they did not survive long enough to be proven right. High leverage, thin liquidity, vague exit plans. Those factors remove investors from the game before the story has truly finished unfolding. This text does not aim to convince you to believe in any specific scenario. It offers only a framework. When price and market behavior no longer align, the correct response is not to react faster, but to understand more deeply. In a world where money can be created without limit, but metal cannot, the ultimate truth does not lie in promises, but in the ability to fulfill those promises. The market will eventually rebalance itself. Paper prices and physical prices cannot remain disconnected forever. The only remaining question is, who has enough patience and enough discipline to remain standing until the two are forced to meet? There will continue to be many issues surrounding the gold and silver markets at the present time due to unpredictable volatility. I hope I will see you again in future videos on this channel. Please remember to subscribe to the channel to continue accompanying us. Thank you, and see you again.